Hey everyone, we have to cover two topics this week. One's about a country, and this is a country people have been telling you to buy or buy into because it's on sale, and that is a mistake. The second is a type of stock that people have been telling you to buy. Maybe your advisor has you in this type of stock, and that is also a mistake. So we have to talk about these two mistakes that people are probably making right now. So we're going to get to those two things and so much more. So stick around. Hey everybody, RC Peck here, and this is my weekly Fearless Wealth weekly update. And today we have two topics to talk about. Now, whether you're 30, 60, or 90, these topics matter because they affect your portfolio, your wealth, your choices, how long it takes you to get to retirement. Can you stay in retirement? The quality of your retirement, how many choices you have. This absolutely impacts. Now, the downside is most of what I talk about kind of goes against what people have been taught. So it's hard to kind of go against your advisor or think differently, but we're not doing it to think differently. We're doing it because it's best for your money. So the first thing I want to talk about is a country to avoid. So let me pop over to the price charts. And this is a tracking ETF. This tracking ETF is FXI. It's the China Large Cap ETF. Now, I've taken dividends out of it. I just want to show it to you this way, almost like it's an index. So I think it's going down to its 2008 low. I believe people should absolutely, positively avoid China. Now look, if it hits its '08 low, which if you can see that at the bottom of the screen, it still has a way to go. I'm going to throw my glasses on here. This symbol can still, I think it still has I can see this symbol falling another 20%. Now, that might not sound like a big deal, but the fact that this symbol is already down 56%, by the time it gets to its '08 low, it's going to be down about a total of 65%. All right, so that's a pretty big deal considering it's China. It's the second largest economy. Now, here's the reason I want you to avoid it. First of all, I want you to avoid it, or I think people should avoid this because it's falling, and I think it has more falling to do. It's getting weaker. Okay, but I don't know if you saw the October 7th announcement out of the Biden administration. And when it comes to China, Trump and Biden are completely aligned. You hate Biden, you hate Trump, you hate politics, blah, blah, blah. These two guys are completely aligned on what the U.S. should be doing with China. So on October 7th, basically, Biden came out. It was through the Commerce Department. He said, no Americans, no American companies, no American technology, no American people, no American equipment, no American software. You get the theme here. Any of that can be supplied to China. That's chips, that equipment, that's people. Also, what this decree, I don't know what it's called politically or economically, what it also said was any countries in the world who are using U.S. technology or U.S. employees, you have to stop. You cannot give any of that to China. This is a really big deal. Okay, add on top of that, I mean, we're talking semiconductors here. They run everything. Okay, add on top of that, China just stopped this week supplying economic data to the world. They just said, you know what? We've indefinitely stopped it. We're no longer going to provide any sort of GDP or economic data coming out of our country. They're literally starting to close off from the world. Now, I don't know where this leads, but I think there's a likelihood, there's a probability, I don't know what it is, maybe 1 out of 10, that all the Chinese stocks in the US get delisted. Right? So this is real risk. This is real risk. Most people get risk confused. Risk isn't how much a stock can fall. Risk is a stock going out of business or a country going out of business. So I suggest staying away from all of that. There's better places to go that have opportunities, but just this theme is stay away from China completely. they may, I mean, look, they are going to invade Taiwan. I don't know when. I did hear, I did read some newsletters, people saying China took Hong Kong. Oh, God, please. China didn't take Hong Kong. Hong Kong was handed back to China from Great Britain after something like 157 years of them, quote unquote, owning it. Hong Kong was handed back in 1997. So no, China didn't take Hong Kong or Macau. Please get your history right. But China may actually take Taiwan for their technology. So that is happening. Okay, so that's the first thing I wanted to cover. The second topic, as important or more important, is when the market falls, what people are taught is go to safer parts of the market, right? You want to go to a safer part of the market, go to staples or go to quality or go to utilities. But specifically, I want to talk about the word quality. So people are buying ETFs that have the word quality, right? Quality in it. Think like Home Depot, 3M, Microsoft, like the bluest of blue chips. So it makes sense. It's not people's fault, but they're like, okay, well, if I'm going to be in the market or if I have to be in the market or I'm not allowed to leave the stock market, because people have told them never leave the stock market. You're never allowed to leave the stock market. What they do is they buy words. And so let me just go and show you what I mean. So look at the screen here. There's two lines. There's two lines on the screen. One, and you can go look up any ETF that has the word quality in it, but this is the iShares Edge MSCI US Quality ETF. It's the red line, by the way. It's the red line. The blue line is just the S&P. So the first thing I really, really, really want everyone to get is when the market goes into these, sub 20% downs, right? Over many, we're now entering our 10th month. We entered our 10th month. It's not where to hide in the market, it's get out of the market, but with a plan. And so the quality ETF is down year to date. I'm just going here, looking, squinting, about 25.5%, where the S&P itself is only down about 21%. Now, the worst thing is people on that red line, they thought they were safer, because the word quality probably loaded up safe to them, which is very expensive. The way I want people to think about this, and the way that I've taught this literally for probably 2 decades, is I want you to think of every asset class like a boat. So just think of this boat as the equity asset class, just stocks, all stocks in the world, mid-cap, international, stock ETF, stock sectors, high-flying stocks, small cap stocks, target date funds, which are basically filled with stocks and funds of funds, stock mutual funds, growth stocks, value stocks, large cap stocks. They're stocks. They are equities. If the equity boat falls 50%, every type of equity is going with it, especially the safe ones. And it's because people over the age of 50, 60, and 70, they own those funds or ETFs that have the word safe or quality in some form. And since people over the age of 60 or 70 have stopped earning, right, they get scared easier than, say, a 35-year-old. And those funds will fall harder. It's counterintuitive, but when you think about it, you're like, oh, that actually makes sense. If a 65-year-old's down 50%, they're more likely to sell than if a 45-year-old is down the same amount. And the big thing is just to know that during market crashes, whether it's 2000, this is just showing you US domestic and international, basically all the stocks, they all fall. Here's 2008, showing you 6 different ways to own the global markets. They all fall in 2008. Here's 2020 COVID market crash. They all fall. The idea is not to kind of shuffle around the deck chairs. The idea is to know when to step aside from the market. Now, this is not me wanting to be clever or cute and use a metaphor of the USS Titanic, which is what that boat was. But metaphors are a great way to really show and impress upon that what's most important is to know whether you should even be on the boat, not because of the year you were born, but just what the boat is doing. And there's only 5 boats on the planet. There's only 5: a stock boat, a bond boat, a cash boat, a real estate boat, and a commodity boat. The stock boat is sinking, sunk. The bond boat is in its worst shape ever. All currencies are crashing except the dollar. So as far as population goes, the US represents 4% of the world population. So that means 96% of the currency boat has sunk. Real estate boat is sinking fast, and the commodity boat is just fine. It's just now going sideways. You don't need 100 places to be safe. You just need one place to be safe. And the sad thing is, it's just not taught. People were taught bonds were always safe. People were taught things called quality or balanced or staples or utilities or high dividend means you are safe. That is not true during these 2008 and 2000 and 1987 and 2020 and 1974 periods. And I believe we are in one of those. And I've been talking about this not just for the last week, but for quite some time. So you still have things you can do, but just I really kind of, my hope each week with these videos is to not try to be clever or make people feel bad, but know that you do not have to be in bonds. You don't have to be in stocks. And a lot of the money in the stock market in the US and on the planet is in sheltered accounts. Tens of trillions of dollars are in accounts that are sheltered from taxes. So there's no tax consequence to it. But even if there is, what happens for a lot of people is and I'll tie it up here. What happens for a lot of people is they'll go, I don't want to pay taxes. I don't want to pay taxes. I don't want to pay taxes at all costs. It's okay to pay taxes, and you will eventually pay taxes, right? So it's okay to pay taxes. And I'd rather have someone lose 16% only or 19% only and pay some taxes on that than lose 65%, because the mind share, that the quality, the peace of mind of not having your $1 million go to 400,000 is hard to measure, right? Because when that money, that $400,000, to get that back to $1 million, it's 150% gain. The market grows at an average of 10% a year. That means you're going to take 15 years to get back to break even. But if your portfolio goes from $1 million to 810,000, that's a lot different, right? That's 19%. That's a much different get back to break even. I appreciate you being in my world. I appreciate you watching these videos. Please forward them if you think they have value. Leave comments. I read them all. I respond to them unless they're selling some sort of Bitcoin whatever thing, and I just delete them. But I do appreciate your time and attention and the comments. And if you are curious about how it would look or feel to have us manage your money, the next step is super simple. You can just either click a link in the description below or a really simple email, hello@fearlesswealth.com, and you say interested or curious in what that would look like if you managed our money, and then we will get in touch with you. Thanks everybody. I appreciate you being in my world, and I will speak to you next week. Bye.